A blessed day to each and everyone. I am Anna from Guadalquiver, and for today's topic, we will be going to discuss about Chapter 14 of Legal Aspects in Tourism and Hospitality entitled Insurance Law. So for the learning objectives, we have to enumerate items that can be insured by a tourism establishment, identify the rationale behind the concept of insurance, explain the different kinds of insurance, and identify the advantages and disadvantages of having insurance. So insurance is a crucial for tourism companies due to the numerous risks involved. Employers can subscribe to employee group insurance, property insurance against fire or earthquake, and marine insurance for sea and cargo transportation. Insurance contracts are governed by the insurance law, with the Civil Code of the Philippines governing in case of deficiency. So, for the definition and concept, Section 2, Number 1, a contract of insurance is an agreement whereby one undertakes for a consideration to indemnify another against loss, damage, or liability arising from an unknown or contingent event. So, a contract of insurance is an agreement where one party, the insurer, agrees to provide financial protection to another party, or the insured. In exchange for a payment or the premium, this protection is against the risk of loss, damage, or liability that may arise from an event that is uncertain or unpredictable. In other words, the insurer promises to compensate the insured if a specific event occurs, such as a car accident, a fire, or a medical emergency. The insured pays a regular fee, or the premium, to the insurer, and in return, the insurer takes in the financial responsibility for the potential loss or damage. So the essential elements of an insurance contract are insurable interest, existence of risk, assumption of such risk by the insurer, said assumption being part of a general scheme to distribute actual losses among those bearing similar risk, payment of a premium. There are also characteristics of an insurance contract. A. The aleatory. There is an element of risk. An aleatory contract is one where the obligations depends upon the occurrence of an uncertain event, as in the case of fire insurance, or one certain to happen but an indeterminate time, like for example death in life insurance. Next, we have contract of indemnity. There is an exchange of value for value, particularly in property insurance. Next, we have onerous. There is valuable consideration given, like payment of premium. Next is bilateral. Both parties are bound to do something. Next, we have formal. As to form a policy is required to be issued and the premium must be paid. The parties in insurance contracts are insurer person, partnership, association, or corporation duly authorized to transact an insurance business. Next, we have insured a person with an insurable interest who stands to benefit from a policy of insurance. In its strict sense, the insured party is the owner or purchaser of the policy, even though benefit of the insurance may accrue to someone else. Next, we have beneficiary, a person designated by the terms of the policy to receive the proceeds of the insurance policy upon the happening of the event insured against. It is a person named in an insurance policy as the one to receive proceeds or benefits accruing thereunder. So next we have insurance contracts. So insurance contracts may refer to the following. First, we have life insurance, an insurance on human lives, and insurance pertaining thereto or connected therewith. Next, we have fire insurance, which includes loss by fire, lightning, windstorm, tornado, or earthquake, and other allied risks when such risks are covered by extension to fire insurance policies or under separate policies. Next, we have marine insurance, a contract whereby one for a consideration agrees to indemnify another for the loss or damage on a certain interest subject to marine risk by certain perils of the sea or specified casualties during a voyage or fixed period. Next, we have personal accidents, accident insurance, in insurance which provides precautionary compensation for expenses or losses of income brought about by death or bodily injured arising from violent external, visible, and accidental means. Next, we have insurable interest. So in section 10, every person has an insurable interest in the life and health. So of any person on whom he depends wholly or in part for education or support, or in whom he has pecuniary interest. Like for example, a parent may have an insurable interest in the life of their child as they depend on them for support. Next, we have of any person under a legal obligations to him for the payment of money or respecting property or services of which death is or illness might delay or prevent the performance. So, for example, a homeowner has an insurable interest in their home as it could be damaged by a natural disaster. Next, we have section 13. Every interest in property, whether real or personal or any relation thereto, or liability in respect thereof, of such nature that a contemplated peril might directly indemnify the insured, is an insurable interest. So, for example, a homeowner has an insurable interest in their home as it could be damaged by a natural disaster. Next, we have section 14. An insurable interest in property may consist in an existing interest. So, an insurable interest in property can be an existing interest, such as owning a car or a house. Next, we have inchoate interest founded on an existing interest. So, it can also be an inchoate interest founded on an existing interest, such as an expected inheritance. Next, we have an expectancy coupled with an existing interest that out of which the expectancy arises. An insurable interest in property can be an expectancy coupled with an existing interest, such as an expected future income from a property. Next, we have section 15. A carrier or depository of any kind has an insurable interest in a thing held by him as such, to the extent of his liability but not to exceed the value thereof. So, for example, a bank that holds a valuable painting in its safe deposit box has an insurable interest in the painting to the extent of its liability. Next, we have beneficiaries. So in section 16, no contract or policy of insurance on property shall be enforceable except for the benefit of some person having an insurable interest in the property insured. So it states that any contract or policy of insurance on property must only be enforceable for the benefit of someone who has valid insurable interest in the property being insured. This means that only individuals who would suffer a financial loss if the insured property is damaged or lost can be benefit from the insurance policy. Next, we have section 19. An interest in property insured must exist when the insurance takes effect and when the loss occurs but need to exist in the meantime. An interest in the life or health of a person insured must exist when the insurance takes effect but need not exist thereafter or when the loss occurs. So it explained that for an insurance policy to be valid, the person holding the policy must have a legitimate interest in the property at the time the insurance policy starts at the time a loss occurs. However, the interest does not need to be maintained continuously between these 2 points in time. Regarding life or health insurance, the person being insured must have a valid interest in their own life or health at the beginning of the insurance policy, but this interest does not need to continue throughout the policy term or at the time of the loss. Next, we have fire, marine, and third-party liability insurance. So, marine protection and indemnity insurance covers the loss or damage of various types of property and interest in relation to navigation, transit, transportation, and other risk. It covers the construction, repair, operation, maintenance, and use of vessels, craft, and other maritime instrument in ocean or inland waterways. The insurance also covers personal injury, illness, death, and damage to property of another person. The policy does not cover life insurance or surety bonds, nor bodily injury insurance for automobile owners. The insurance also covers the loss or damage of valuable items during transportation or storage. Next, we have fire insurance. Section 167, as used in this code, the term fire insurance shall include insurance against loss by fire, lightning, windstorm, tornado, or earthquake, and other allied risks when such risks are covered by extension of fire insurance policies or under separated policies. So for example, let's say you have a fire insurance policy for your home. This policy covers damages caused by fire. However, if your policy includes an extension for windstorm coverage, it means that if your home is damaged by a windstorm, such as a hurricane or tornado, the policy will also provide coverage for those damages. Next, we have compulsory motor vehicle liability insurance. So this chapter defines a motor vehicle as a vehicle used for transportation of passengers for compensation, including those authorized by law or the operators against agents. I mean, a third party is any person other than a passenger, including a member of the household or family within the second degree of consanguinity or affinity of a motor vehicle owner or land transportation operator. An insurance policy or policy refers to a contract of insurance against passenger and third-party liability for death and bodily injuries arising from motor vehicle accidents. It is unlawful for any land transportation operator to operate in public highways without a policy of insurance or guarantee in force. So for instance, if the driver's siblings or spouse is involved in an accident caused by the driver, they would be considered a third party. The insurance policy or policy in this scenario would be the contract of insurance that provides coverage for passenger and third-party liability. It would protect against death and bodily injuries arising from motor vehicles accidents involving the ride-sharing service. Next, we have war risk insurance. War risk insurance is an insurance covering damage caused by acts of war. It includes coverage for war, hijacking, and related perils. Insurers have intended to withdraw liability coverage for weapons of mass destruction or WMD, a subset of war risk insurance. WMD includes radioactive contamination or dirty bombs, electromagnetic pulse devices, chemicals, or biological weapons. So for the conclusion, insurance law is designed to protect individuals, businesses, and the public by regulating the insurance industry and ensuring that people have the necessary coverage to address potential risk and liabilities. It establishes the requirements for insurable interest, outlines the types of coverage available for different situations, and mandates the need for insurance in a specific context, such as motor vehicle operation. Overall, insurance law aims to provide a framework for fair and responsible insurance practices that benefit both policyholders and public. And that is all about Chapter 14. Thank you and God bless.